Hello everyone. Today we would like to present our project titled A Systematic and Adaptive Allocation Model for Cryptocurrency Portfolios. The motivation of this study comes from a fundamental contradiction in the cryptocurrency market. On one hand, cryptocurrencies offer extremely high return potential. On the other hand, they are characterized by extreme volatility, unstable correlations, and strong speculative behavior. Therefore, instead of focusing on short-term trading signals or price prediction, our project focuses on portfolio construction, that is, how to allocate capital systematically under high uncertainty. Next, we're going to talk about the background, which is problems in crypto investing. Most cryptocurrency investors construct portfolios based on narratives or trends, such as AI, DeFi, meme coins, or layer 2 solutions. However, this approach often ignores risk structure. When market sentiment changes, these assets tend to move together, leading to severe drawdowns. As shown in this slide, single asset strategies may generate explosive returns in certain periods, but they also suffer from sharp decline. In contrast, a diversified and systematic portfolio provides smoother performance and better risk-adjusted returns. This observation aligns with classical financial theory. Long-term investment success depends more on risk control than return chasing. Next is research objective. Based on this background, our research focuses on the following key question. How can we build a cryptocurrency portfolio that is robust, adaptive, and risk-aware across different market environments? To answer this question, we aim to, first, structure the crypto market instead of treating it as a collection of isolated coins. Second, replace narrative-based decisions with data-driven risk analysis. Third, allow the portfolio to adapt dynamically to changing market regimes. And then here is the overall framework. This slide presents the overall framework of our model. We adopt a top-down, multi-layered allocation process, which consists of three main layers. Layer 1 is thematic sector classification. Layer 2 is data-driven risk clustering. Layer 3 is portfolio optimization. This layered design allows us to manage risk progressively rather than relying on a single optimization step. In Layer 1, we classify cryptocurrencies into thematic sectors based on their economic roles and market narratives. Examples include top 10 cryptocurrencies, Layer 1 and Layer 2 infrastructure, DeFi applications, meme coins, real-world assets, AI-related tokens. Within each sector, we apply equal weighting. This is an important design choice because it prevents large cap assets, such as Bitcoin or Ethereum, from dominating the results and masking sector-level behavior.
Although thematic classification is intuitive, it has an important limitation. During market stress, correlations between different sectors often increase significantly. As a result, portfolios that appear diversified across themes may still suffer from hidden risk concentration. This phenomenon is well documented in traditional financial markets and is even more pronounced in crypto markets. Therefore, thematic labels alone are insufficient for effective risk management. To address this issue, we introduce Layer 2, which focuses on actual market behavior. We use K-means clustering and unsupervised machine learning algorithm to group sectors based on quantitative characteristics rather than names. The features used include mean return, volatility, and Sharpe ratio. By doing so, we identify risk clusters, groups of sectors that behave similarly under market conditions. Next, the financial interpretation of risk clusters. Each risk cluster represents a distinct risk-return profile. For example, some clusters exhibit high volatility and aggressive return patterns. Others show defensive characteristics with lower volatility. This approach is conceptually similar to factor investing in traditional finance, where assets are grouped by common risk exposures instead of industry labels. Thus, our model treats crypto sectors as risk factors, not independent bets. In Layer 3, we construct the final portfolio using a two-step optimization process. First, we allocate capital across risk clusters using maximum Sharpe ratio optimization, explicitly incorporating the risk-free rate. Second, we distribute the cluster-level weights back to the sectors within each cluster. This hierarchical approach ensures diversification across risk sources while maintaining optimal risk-adjusted performance. Let's talk about the market regimes and how we design the risk-free rate. To evaluate the robustness of the model, we test it under two contrasting market regimes: a bear market period and a bull market period. An important methodological detail is that we use a dynamic risk-free rate based on weekly U.S. Treasury bill yields. This avoids overstating Sharpe ratios and makes the model more realistic from a portfolio management perspective. Let's talk about the bear market results first. During the bear market, the model adopts a defensive allocation strategy. Capital is concentrated in relatively stable sectors such as top 10 cryptocurrencies and real-world asset-related tokens. Highly speculative sectors such as meme coins or DeFi receive minimal weights. This indicates that the model prioritizes capital preservation when downside risk dominates. In contrast, during the bull market, the model becomes more aggressive and concentrated. Nearly 90% of the portfolio is allocated to the top 10 sector, which provides high liquidity, strong momentum, and superior risk-adjusted performance. This concentration is not a failure of diversification, but an optimal response to increased correlations and strong upward trends. By comparing both market regimes, it highlights the adaptive nature of the model. In bear markets, it's defensive and diversified, but in bull markets, it's concentrated and return-oriented. All allocation changes are driven by observed data rather than discretionary judgments or emotion. In conclusion, our model contributes in three key aspects. First, it shifts crypto portfolio construction from narrative-driven to risk-driven. Second, it integrates financial big data with machine learning techniques. Third, it adapts dynamically to different market environments. Rather than predicting prices, the model provides a systematic decision-making framework for crypto portfolio management.
First, we allow users to specify a clear analysis period to ensure that all comparisons are conducted under the same market conditions. Next, cryptocurrencies are categorized based on their functional roles and market positioning into several groups, including top 10, layer 1, layer 2, DeFi, meme, AI, and RWA. Each cryptocurrency is assigned to only one category to avoid double counting. In the data collection stage, the model retrieves historical price data for cryptocurrencies in each category and simultaneously incorporates U.S. short-term Treasury yields as the risk-free benchmark. Prices are then converted into returns, and within each category, returns are equally weighted and averaged to represent category-level performance. The data are further converted into a weekly frequency to better align with asset allocation decisions. The second stage is the first layer of analysis at the sector level, where we compute each category's average return, volatility, and Sharpe ratio. This step is intended to summarize the basic risk and return characteristic of each category, rather than to make allocation decisions directly. The third stage involves clustering analysis. Based on category level return, volatility, and Sharpe ratio, the model groups sectors with similar market behavior into clusters, using the bear market period from November 2021 to December 2022 as an example. Most categories such as top 10, layer 1, meme, AI, and RWA are grouped into the same cluster. indicating similar risk and return behavior during the period. In contrast, DeFi and certain Layer 2 categories are separated due to differences in their risk structures. This example is used to illustrate how the model produced clustering results under the real market conditions. In the final stage, portfolio allocation is performed at the cluster level based on return, volatility, and Sharpe ratio. The resulting weights are then mapped back to the sector level to obtain final allocation weight. Basic allocation constraints are applied to prevent excessive concentration in a small number of categories. In summary, this framework adopts a two-layer structure, sector first, then cluster, and combines clustering with portfolio analysis to demonstrate how the model organizes risk characteristics and generates allocation outputs under different market environments.